This video is going to be about unearned or deferred revenue. But as you can see here on the screen, I have prepaid expense as well. That's going to be incorporated into this topic here about unearned revenue. I already made another video of prepaid expenses, so check that out before watching this video. But the reason why I'm bringing in prepaid expense into this unearned revenue example is because you will be able to see how the accounting is done on the tenant side. The person is actually paying the cash, and then also how the accounting done on the landlord side as well. Okay, you'll see pretty much how the accounting works for both parties because they're doing business with each other. Okay, so we're going to say that the tenant and the landlord agreed to a $6,000 advance payment for 6 months beginning on January 1st from the tenant to the landlord. So as of January 1st, an advance payment was made of $6,000 to the landlord for 6 months starting in January 1st. So let's do the books, or look at the books for the tenant side, because the tenant is the prepaid expense example, specifically rent. All right, so we're going to use on the tenant side January 1st. That's January 1st, 1/1. Then the account that we're going to credit first is going to be cash, because cash was paid to rent out a facility for 6 months. I'm just pretty much improvising at this point. So cash is going to be credited for $6,000. Okay, that's going to decrease the balance in that cash account. Okay, and so the debit is going to go to an account called prepaid rent. Okay, prepaid rent is an asset. So to increase the asset, we'll debit it. All right. So I'm going to draw an arrow right next to the $6,000, an arrow up indicating that that's an increase in $6,000 in that prepaid rent account. And for the cash, the credit column here where you see $6,000 is credited, I'm going to put down a arrow. My arrows are crooked, not even in a straight line. So I drew an arrow down indicating that that's a decrease in cash. Okay. Now, what does it look like for the landlord? Because the landlord, this is the unearned revenue example. So the landlord is going to use the same date, January 1st, 1/1. Okay. And then the account that's going to be used, well, this is $6,000 that the landlord received from the tenant. So this is going to be cash that's going to be increased in the landlord's cash count. So we're going to debit cash for $6,000. Again, that's going to indicate an increase in the balance in that account. Okay. Now, what account is going to be credited? The account that's going to be credited is going to be either unearned revenue or deferred revenue. So they mean the same thing, unearned, deferred. Okay, so credit, we're going to credit this account for $6,000. That's going to increase this liability account, because this is a liability account. All right, so take a look at both of these entries here. So we look on the tenant side, we see that the cash went out. Where did the cash go? It went to the landlord. All right. So the landlord increased their cash. Tenant didn't decrease the cash. Okay. And what was it for? For the tenant, this is prepaid rent. This is rent that's, I'm going to say this is an advance payment for rent of 6 months that was paid initially on January 1st. So this will go to the prepaid rent account as an asset, because the tenant has the right to use the landlord's facility for 6 months as of January 1st. So on the landlord side, that cash is essentially a liability, because they have to put some work in that cash that they receive, that was received in advance. So this is why the unearned revenue account, the liability account, is going to be credited for $6,000. So the landlord has to allow the tenant to stay in this facility for 6 months, or work in this facility for 6 months. Okay, because they already received the cash payment. Okay, now on January 31st, what does it look like as far as with how is the expense going to be recognized on the tenant side, and how is the revenue going to be recognized on the landlord side. Okay, and this is because the first month has expired, or it already went through, okay, or went by. So this means that we're gonna, figure out what the monthly rate is going to be, on the monthly rent is going to be. So we're going to take $6,000 and divide it by 6 months, right? I hope so. Let me receive. Yeah, 6 months. Okay, so that's going to give us $1,000 a month that we're going to have to recognize or report as an expense. Okay, so we're going to first, over here on the tenant side, we're going to debit. No, let me start off with the credit. We're going to credit prepaid rent. Okay, we're going to credit this account for $1,000, and we're going to move this balance into an expense account called rent expense for $1,000. Okay, so we just moved a month's worth of the balance from the prepaid rent asset account into the actual expense account. Okay, now what does it look like on the landlord side? So landlord, same January 31st. Okay, so for the landlord is now going to take this unearned revenue account here, and now they're going to pretty much debit this account for $1,000. Okay, same as this amount. So this is a liability account, and by debiting this liability account, you are reducing the balance in that account. Okay, and where is it getting transferred to? It's getting transferred to an actual revenue account called rent revenue, and that's going to be credited for $1,000. So that's exactly how it's going. So looking at this second entry here in January 31st. So for the tenant, we see that an expense was recognized of $1,000. So that debit increased the balance in that account. On the landlord side, we see a revenue was credited for $1,000. That's increasing the balance in that account, and that's because the landlord earned that revenue because the tenant used the facility for that month. So this is an example of unearned revenue.